Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. So it's Friday, October 3rd, 2025, and our mission today, really, is to try and make sense of this market landscape.
Yeah.
Because, frankly, it feels like two different realities kind of glued together.
It really does. A definite split.
You got the Dow, S&P, NASDAQ all hitting fresh all-time highs. I mean, record highs again yesterday. And yet, the U.S. government is, day 3 of a shutdown?
Exactly. And at the same time, you've got this incredible flood of money into artificial intelligence, these soaring valuations.
But also these really loud bubble warnings coming from serious institutional players.
That tension is the core story today, absolutely. It's a fundamental decoupling, you could say.
Yeah.
If you look across the major outlets, CNBC, Reuters, Bloomberg, Yahoo Finance, the split is just stark.
How so?
Well, you've got this pure technological euphoria, right? This belief in the almost unstoppable power of AI. And that's clashing head-on with some pretty serious underlying financial instability, political gridlock, even geopolitical risks bubbling up.
So how do these things coexist? That's what we need to figure out.
Let's try.
Okay, let's unpack this AI frenzy first. Because the amount of capital involved, it's just breathtaking. This isn't just a trend. It feels more like a financial reordering.
Oh, completely. Reuters, using PitchBook data, they confirmed AI startups globally raised a colossal $73.1 billion.
$73 billion in Q1 alone.
In the first quarter of 2025 alone, yes. And think about this. That accounted for 57.9%, nearly 60% of all global venture capital funding in Q1.
Wow. 6% into AI.
It's huge, and it's driven by these massive key raises. You know, OpenAI's $40 billion round obviously stands out, but also huge funding for Anthropic, for xAI. The velocity of the money is just unprecedented.
And yet, even as all this cash is pouring in, the institutional warnings are getting louder, suggesting this whole rocket might be running on, pure hype.
That's the fear. What are the heavy hitters saying?
Yeah, what are they saying?
Well, they're highly concerned. Take Brian Yeo. He's the group CIO at GIC, and GIC, for you listening, that's Singapore's sovereign wealth fund. So, a very sophisticated global investor.
Right. What's his take?
He's straight up calling it a hype bubble, specifically in the early stage venture space. He told Reuters point blank that market expectations could be way ahead of what the technology could deliver.
Okay, way ahead. Why? Is it just the price? Or is it that the tech, or maybe the infrastructure, isn't quite ready to support these massive valuations yet?
It seems to be both, but maybe leaning more towards implementation challenges. The core tech is phenomenal, no doubt, but GIC seems to suggest we're hitting scaling issues.
Right.
Moving from a cool prototype to mass industrial adoption. That takes time, it takes huge infrastructure investments, specialized talent pools, and these valuations. They seem to be pricing in immediate, perfect execution, perfect monetization, which might take years, if it happens at all for some of these models.
He also made an interesting point about the wider economy, didn't he?
Yeah.
Something about AI spending masking underlying weaknesses.
Yes, exactly. He suggested this current major AI capital expenditure boom, all the spending on chips and data centers, might actually be masking some of the potential weaknesses that might be going on in the economy. Like the enthusiasm for the AI future is making us overlook present-day risks.
That's a sobering thought.
Absolutely. And look specifically at the private markets where a lot of this VC money is landing. The valuations aren't just high, they're, alarming is maybe the right word.
Oh, alarming.
Goldman Sachs, this was reported by CNBC, noted some private companies are being valued at 50 times, 60 times, sometimes even 100 times revenue multiples.
100 times revenue. Not earnings, revenue.
Revenue. That is textbook frothy territory. In some cases, it's even exceeding .com era metrics.
Sounds like a high-stakes game of musical chairs.
It really does, especially when you factor in the competitive risk. CF Private Equity apparently relayed the sentiment they're hearing, that there's maybe a 5% chance, which sounds small but is actually significant in this context, that some current AI business models might be totally invalid in 10 years.
Because the tech changes so fast.
Exactly. What if the next big foundation model just makes your whole current business obsolete overnight? That's a kind of existential risk that, traditional investors just don't usually face.
Okay, so that's the AI hype and the warnings.
Yeah.
But here's where it gets really paradoxical this week, right? For all this focus on tech, on AI, on semiconductors, Bloomberg pointed out this unexpected, almost quiet market winner this year.
Ah, yes, the counter-trend trade. safety assets.
Gold, right.
Gold equities, yeah. It proves investors are kind of running in two directions at once, towards speculative tech and towards historic safety. A gauge of global gold equities from MSCI Inc., it soared about 135% in 2025.
135%. That absolutely blows away the global semiconductor gauge, which is up, what, 40%?
Yeah, it vastly outpaces it. And the valuation difference really tells the story about where the perceived value is right now versus just momentum.
How so?
Well, at the Gold Miner Index, it's trading below its 5-year average, about 13 times forward earnings. So arguably still offers relative value.
But chip gauge, meanwhile, way above its average, around 29 times forward earnings.
Big difference.
Huge. And gold's rally isn't complicated. It's driven by classic factors. Expectations the Fed will cut rates eventually, geopolitical tensions pushing central banks to buy more gold, and this bigger, slower trend of de-dollarization globally.
So the market's essentially using gold as an insurance policy.
Against the very instability that the AI boom is maybe helping us ignore.
Exactly.
Meanwhile, the AI product competition just keeps heating up. OpenAI Sora 2, the text-to-video thing.
Oh, yeah, that's going viral. Some stunningly realistic clips, like that one of Sam Altman supposedly shoplifting GPUs.
Right. And CNBC reports that ability, that immediate visual power, is actually sparking debate inside OpenAI about balancing safety and guardrails versus, creative freedom and just getting it out there fast.
It's a classic tech dilemma, amplified. And the competition's hitting search, too. Perplexity AI is making a big move.
The Comet browser.
That's the one. They're rolling out their AI-powered Comet web browser for free worldwide. Now, remember, they initially launched it just for their premium subscribers, charging $200 a month.
$200 a month. Wow. So free now is a big shift.
Massive shift. According to CNBC, it puts them in direct competition with Google, OpenAI, Anthropic, all the big players in that AI agent space. Going free suggests they're prioritizing market share, grabbing users now over immediate revenue. It signals a huge land grab is underway.
Okay, let's shift from the AI frenzy, fascinating as it is, to the traditional markets.
Yeah.
Because their resilience is, well, also remarkable, especially given the political mess in Washington.
It really is. The Dow, S&P 500, NASDAQ all hit fresh all-time highs again on Thursday. And this is while the U.S. government shutdown is hitting day 3 today, Friday.
So investors are just shrugging it off.
Apparently. They're clearly dismissing the political uncertainty for now. Seems like they're betting on the corporate economy's strength to just power through Washington's dysfunction.
Even though Treasury Secretary Scott Bessent warned, according to CNBC, that the shutdown could eventually take a hit on economic growth.
Right. The market seems to be saying, we'll worry about that later. Right now, they're looking past the headline, chaos.
And the economic signals we do get are kind of contradictory, aren't they? We don't have the official Bureau of Labor Statistics jobs report because of the shutdown.
Correct. No BLS data.
But Chicago Fed data, cited by CNBC, apparently shows U.S. hiring is at its slowest pace since 2009, down 58% year-to-date. That sounds bad.
It does sound bad, but then the jobless rate is holding steady at 4.34%.
Slowest hiring since 2009, but steady unemployment. How does that work?
Well, this fits exactly what Fed Chair Jerome Powell described as the low-fire, low-hire economy. Companies are hesitant, maybe nervous about expanding, so they're not hiring much. That's the low-hire.
Okay.
But they're confident enough, or perhaps just hoarding labor, so they're not firing their existing employees either. That's the low-fire. It keeps the jobless rate stable.
So underlying stability in who has a job, but real caution about adding jobs or investing in expansion.
Precisely. Extreme caution regarding expansion capital, it seems.
Okay. Now, against this backdrop political noise, cautious economy, we still saw some major corporate moves this week, Berkshire Hathaway stepping up.
Yeah, Warren Buffett's Berkshire Hathaway acquired Occidental Petroleum's petrochemical unit, OxyChem, for $9.7 billion, all cash.
That's his biggest deal since 2022, right? What does that signal?
Well, it definitely signals confidence in traditional energy and related chemical infrastructure. These tend to be pretty stable cash generators, regardless of tech hype cycles.
Interestingly, though, Occidental shares actually fell after the announcement, over 7% on Thursday.
They did, but that probably wasn't about the deal itself. It more likely reflected broader crude oil prices hitting a 4-month low. Just shows how volatile that energy sector remains, even with a Buffett buy-in on a division.
Got it. On the auto front, completely different story for Tesla. Blowout Q3 deliveries.
Absolutely blowout numbers. 497,099 units globally. Easily beat estimates.
And Yahoo Finance suggested this might be buyers rushing before that big federal EV tax credit expires, the $7,500 one.
That seems very plausible. That pull-forward effect is probably a big factor here, juicing demand temporarily before the credit goes away.
Important context.
Very important, because while Tesla's booming, especially with these U.S. numbers, they do still face headwinds elsewhere. We saw European registrations drop notably back in August due to competition and maybe some political friction.
Right. And how's their main competitor, BYD, doing?
Contrast that with China's BYD. They actually reported a 6% fall in deliveries year on year for September. So the global EV market overall is facing some deceleration challenges. Tesla's U.S.-driven Q3 really stands out against that backdrop.
We also saw huge momentum in a legacy tech player, Intel. Stocks up 50% in the last month alone.
Incredible run for Intel. And here's a fascinating detail from CNBC. That surge has significantly boosted the value of the U.S. government's 10% equity stake in the company, which they negotiated back in August.
How much is worth now?
Roughly $16 billion.
Wow. So that stake came from the TCHIPS Act funding.
Primarily, yes. The surge follows successful new tie-ups and is largely funded by those CHIPS and Science Act grants. It's kind of an early validation, you could argue, for that government strategic investment approach, showing it can deliver pretty rapid paper returns, at least.
And it's not just U.S. markets feeling bullish. Europe, too.
Absolutely. The sentiment's global. The Pan-European Stocks 600 Index, CNBC reported, was extending gains again today, Friday. It's on track for its fifth straight day of gains and a weekly gain over 2%. It recently hit a record high, too.
Any particular sector standing out in Europe?
Tech is strong there as well. The Stocks Europe 600 Technology Index is tracking nearly a 5% gain for the week, apparently revitalized by that huge OpenAI share sell we talked about earlier. Seems to have lifted the whole tech boat.
So the underlying story is the same everywhere. Markets rewarding growth, especially tech growth, and kind of ignoring the political risks for now.
That seems to be the dominant narrative in the short term, yes. They're willing to look past a lot of fundamental political or economic uncertainty to capture that growth, especially when AI is involved.
Okay, let's pivot now to the political and regulatory front. Because some really significant things happened there this week, potentially with long-term consequences, starting with pharma.
Yes, the Pfizer drug pricing deal. Bloomberg had a great breakdown of the complex negotiation behind that. It followed months of deadlock over how to lower U.S. drug prices.
What broke the deadlock?
Well, according to officials familiar with the talks, the key turning point was direct pressure from the White House. Specifically, President Trump's post on Truth Social back on September 25th.
What did he post?
He threatened a 100% tariff on any branded or patented pharmaceutical product unless Pfizer committed to building its manufacturing plant in America. That threat, apparently, was the lever that finally moved the negotiation.
100% tariff threat.
Wow.
Yeah.
And it worked. It seems it did. Pfizer conceded on two big points. First, they agreed to launch new medicines in the U.S. at price parity with other developed nations, something the industry has fought against for decades.
That's huge. What was the second point?
They also agreed to offer low-income and disabled adults a comparable price insurance program.
So real concessions on pricing. What did Pfizer get in return?
They secured a crucial 3-year grace period from those threatened tariffs. But the precedent set here is massive. The U.S. government successfully used trade policy tariff threats to force domestic price concessions on a major pharma company.
Sets a template for future negotiations, potentially across the whole sector.
Absolutely. A seminal moment for the industry, potentially.
Okay, moving from pharma pricing to platform regulation.
Right.
This week also saw a really charged move involving Apple and an app called IceBlock.
Right. Apple removed the IceBlock app from its store. This app allowed users to anonymously report sightings of Immigration and Customs Enforcement, or ICE, agents.
And this followed pressure from officials.
Yes, specifically pressure from Attorney General Pam Bondi, according to CNBC. The context here is really intense, tied into controversy over aggressive immigration enforcement tactics.
Was there a specific trigger event mentioned?
There was. Law enforcement data apparently indicated that a gunman who attacked a Dallas ICE facility, an attack that tragically led to 2 detainee deaths, had searched for tracking apps like this before the incident.
Oh, wow.
So ICE's acting director, Todd Lyons, came out strongly condemning the app. He said it was effectively painting a target on federal law enforcement officers and cited a frightening 500% increase in assaults on ICE officers.
But the app developer had a completely different perspective.
Completely different. The developer, Joshua Aaron, framed the app as a necessary tool for immigrant communities, a response to what he saw as escalating deportation efforts. He even drew parallels to Nazi Germany, arguing the app provided essential safety information for people living in fear.
So this one app removal really encapsulates a huge cultural and political clash. Safety of law enforcement versus civil resistance and safety of vulnerable communities.
Exactly. And as we report on this, it's crucial we just present these highly contrasting viewpoints factually without taking a side or endorsing either perspective. It's a really complex issue.
Understood. Okay, shifting gears back towards finance, but still with a regulatory angle. There are growing concerns about what's being called the democratization of private equity.
Yes, the rush of retail money into private markets.
What's driving that?
Well, it's partly enabled by regulatory changes, including a Trump administration order that allowed retirement plans like 401ks to potentially invest in alternative assets like private equity and hedge funds.
And institutional investors aren't happy about this.
Not at all. Big players, including GIC again, are deeply alarmed. CNBC reported on their concerns, which are pretty multifaceted.
Like what?
Well, first, there's the worry that a flood of less sophisticated retail money could distort pricing in private markets and ultimately erode returns for everybody, including the institutions.
Makes sense. What else?
Second, it could lower underwriting standards. If fund managers suddenly have vast amounts of new retail capital they need to deploy quickly, they might be tempted to do deals they otherwise wouldn't or pay higher prices.
Okay.
And third, maybe the most critical concern is that it could destabilize the actual fund structures themselves.
Destabilize them. How? Talk more about that instability. Isn't money just money?
Not quite, because of liquidity, or rather, illiquidity. You see, traditional private equity funds are built for long-term commitments. Investors lock up their money for maybe 10 or 12 years.
Right, that's the whole point. Long-term, illiquid investment.
Exactly. But retail investors, even accredited ones who qualify, often don't have that same tolerance for illiquidity. They might expect to be able to get their money out sooner, especially if markets turn rough.
So how are fund managers handling that mismatch?
They're trying to bridge the gap by creating these semi-liquid funds. These funds often promise investors the ability to exit monthly or quarterly, trying to mimic the feel of a mutual fund.
That sounds appealing. What's the catch? What's the risk there?
The risk, as experts are warning, is that these funds might not actually be truly liquid when it matters most during a market stress event. Meaning, if the market tanks and suddenly a large number of retail investors all try to use that quarterly exit option at the same time, the fund manager faces a huge problem. They can't just sell the underlying private companies or illiquid assets quickly to meet those withdrawal requests without taking massive losses.
So they'd be forced into distressed selling.
Precisely, which could hammer the fund's value, destabilize the whole structure, and really hurt the long-term investors who plan to stay in. That structural mismatch between the illiquid nature of the assets and the perceived liquidity offered to retail investors is a huge potential risk just waiting to be tested.
A ticking time bomb, maybe.
Could be.
Okay, finally, let's just quickly touch on the geopolitical front, because that instability remains a major backdrop influencing spending and investment. Any key developments there?
Well, rhetoric remains high. Russian President Vladimir Putin issued a warning about the potential U.S. supply of long-range Tomahawk cruise missiles to Ukraine. He said that would mark a completely new stage of escalation.
More escalation risk. How's Europe responding to regional tensions?
They're bolstering defenses. In response to recent Russian airspace incursions, European leaders backed plans to establish a physical drone wall along the eastern flank to deter Russian aircraft and drones.
The drone wall. Wow. And this is fueling defense tech spending?
Massively. It's driving a boom back in Silicon Valley and elsewhere. We've seen huge amounts pouring into defense technology startups lately.
What kind of startups?
They're sometimes called neoprimes. These agile, tech-focused defense companies are raising billions, focusing heavily on dual-use tech like AI, autonomy, advanced sensors, things needed for this shift towards great power competition-style warfare.
And billions being raised there, too.
Absolutely. Venture funding just for U.S.-based defense tech startups was around $38 billion just through the first half of 2025. It shows how the market is directly responding to geopolitical instability by funding next-gen defense capabilities.
Okay, so let's try and synthesize this whirlwind of a week.
Yeah.
October 3rd. It really feels defined by this massive, almost conflicted allocation of capital, doesn't it?
It really does. You had investors chasing these super high-risk, high-reward AI bets, almost shrugging off clear bubble warnings from sophisticated players.
Well, at the same time, buying traditional safety assets like gold.
Exactly. And meanwhile, major corporations and even the government were finalizing these huge strategic deals in quite traditional sectors, pharma with Pfizer, traditional energy with Berkshire buying OxyChem, and even hints of more government involvement in strategic minerals, like USA Rare Earth confirming close communication with the White House.
And all this against the backdrop of record market highs, Dow and S&P hitting new peaks, even with the government shutdown and geopolitical tensions simmering. The market optimism seems completely decoupled from that political uncertainty.
It does. It's a highly selective optimism, laser-focused on the perceived foundational shift driven by technology, particularly AI. While at the same time, the institutional money, even while participating, is clearly hedging against the risk that maybe that foundation isn't quite as solid as the market thinks it is right now.
It's a fascinating duality. Really defines the macro environment at this moment. So for you, our listener, maybe here's a final provocative thought to chew on this weekend. Which of these powerful trends do you think will ultimately dominate the macro picture going forward?
Is it the potentially foundational structural shift promised by this AI-fueled technology boom?
Or is it the maybe more fragile liquidity and valuation challenges being created by this flood of money, especially the democratization of private markets we just talked about?
Because the answer to that question really dictates whether all this froth just kind of settles down harmlessly, or if maybe the underlying financial foundation starts to show some cracks.
An excellent point to ponder. That's our deep dive for today. We'll see you all Monday morning with new headlines from major financial magazines.